GCC, how it has been performing over the last 10 years, and we can look at the period between 2014 and 24. This is incidentally was a period when commodity prices started correcting in last quarter of 14, and then that correction kind of continued for a long period of time. And because the economy is dominated in GCC by oil, the growth actually was slower, a little bit anemic. And I think if you look at the total period of that 10-year, economies grew by about just less than 2%. The good thing that we've seen is that over this period, as the economies have diversified away from oil, you can see manufacturing coming in, we can see trade coming in, and we can also see tourism-related hospitality industry spend going up, combined with the infrastructure investment that these governments have pushed through the economies. We have seen the economies diversifying quite nicely. And last year, we saw the economies growing by a very healthy 4.5%. If we keep everything else constant, we are looking at the GCC economies growing by, again, the same ballpark of around 4 to 5%. So the outlook is quite positive, and it's coming off the back of an anemic decade, primarily driven by commodity price correction, lower oil prices. Looking at the interest rate outlook, it has changed of late, coming off a scenario where the interest rates were projected to be declining on the back of inflation, which is finally coming under control. The changing landscape on the geopolitical front has now changed the whole environment, and the market analysts are expecting the rate environment to change from declining to maybe stable to slightly increasing. And what we need to really do is to stay close to the market and read all these indicators and being able to respond to this changing scenario in a fairly fast and a nimble way. And what the market expects, one thing civilized, is for the governments here in the GCC to drive infrastructure investment and continued diversification away from energy, oil and gas. And that will then attract foreign direct investments into the region. So we see that flow to resume to its previous levels, and maybe even better than the previous levels. So our long-term outlook remains quite positive on both the local investment and foreign direct investment coming into the region. In the current uncertain scenario, there are always segments which are going to get affected in the short run, and there are segments which are looking much better than other segments. A few examples that come to mind right away: food commodities, for example, computer equipment. As more and more people are working from home during this period, there is certain upsurge in the demand of laptops, for example, for servers, for routers, and we are seeing mobile phone demand actually go up in this period as well. So there are sectors like food commodities, food oil, electronics, computers, laptops, even printers, printer cartridges. People are into supplies. Those segments are doing well. Their margins are up. They are actually running to actually increase their inventory stock levels. And therefore, banks are working closely with these customers operating these segments to give them that working capital that they need right now. So that's a clear opportunity for us. If you look at the other side, we have, for example, tourism-related industry, the restaurant industry. They are actually going through a down cycle right now because the tourist arrivals are not there. People are not spending. The discretionary spend has gone down. And those are the people that we are working very closely to basically help them tide through this period as the working capital cycle or the cash conversion cycle is now extended. And this is the time where we actually build stronger bonds with our customers through this period, because if you hold the customer's hand through this difficult period, you basically build a bond that actually lasts a lot longer in terms of relationship strength. So we see this honestly as an opportunity across all segments that we operate in. The segments which are experiencing a downturn and the segments which are experiencing an upturn. And we're working closely with both these customer sets. So yeah, it's actually an opportunity or a silver lining in every way you look at it.